Kia ora koutou katoa, ko Michelle Lombard toku ingoa. I'm Michelle Lombard, the recently appointed Director of Accounting Standards at the External Reporting Board. I'm joined today by Gali Sluisberg and Carly Berry, who will take you through the projects that they've been working on. But before they do, I might just kick this session off with some housekeeping matters. Firstly, please drop all questions into the chat and we'll try to get to them during the course of this webinar. It's also important to note that this webinar will be recorded, as you can see. The slides and the recording will be made available on our website shortly after this presentation. The External Reporting Board is an independent Crown entity responsible for developing and issuing standards. We look at three pillars, mainly accounting standards, audit and assurance and ethical standards, as well as climate-related disclosures and integrated reporting standards. This webinar, we are focused on updating our accounting standards for for-profit entities. Today, we'll be covering off recently issued accounting standards and amendments, specifically dealing with disclosures of fees for audit firm services. Thereafter, the majority of our time will be spent on NZ IFRS 18, presentation and disclosure in the financial statements. That's a recently published standard that's getting quite a lot of attention at the moment. Thereafter, we'll be covering off an IFRIC agenda decision dealing with the climate-related commitments. We'll have a sneak peek of what's on the horizon for accounting standards. And lastly, we'll end up with some questions. I'll now hand over to Gali to take you through recently issued accounting standards and amendments.
Thank you, Michelle, and kia ora, and hi, everyone. So firstly, let's have a look at standards and amendments that have become mandatory for the first time in this financial year and in the next couple of years. So if you have a March, June, or September year end, then the new standards and amendments on this slide and on the next slide would be mandatory to apply for the first time in your 2024 year-end financial statements. These new standards and amendments also will have applied for the first time to December 2023 year ends, but I'm assuming that those of you with a December year end are probably already finished preparing your December 2023 financial statements. So if your organization is an insurer, then the big ticket item for you on this list is the new insurance standard, NZ IFRS 17 insurance contracts. If you are an insurer, though, then depending on your year end, you're probably in the later stages of finishing your reporting under this standard for the first time, or at least you will be well into the implementation process of the standard. So I'm not going to focus on the requirements of NZ IFRS 17 in detail. If you are not an insurer, then you can see that there is not much in the way of significant changes this year. We have disclosures of accounting policies, so these amendments clarify that entities should disclose the material accounting policies and add guidance on how to identify which accounting policies are material. And then we have disclosures of accounting estimates, which clarify the difference between changes in accounting estimates and changes in accounting policies. And this difference is important because generally changes in accounting policies are applied retrospectively, meaning restatement of comparatives, whereas changes in accounting estimates are generally applied prospectively, which means that prior period comparatives don't need to be restated. And we also have a couple of amendments that relate to tax, particularly deferred tax. One of those relates to the recognition of deferred tax on assets and liabilities that arise from the same transaction, like say a right of use asset and a lease liability that arise from entering into a lease agreement. And then the other amendment relates to the international tax reforms that are known as the Pillar 2 model rules. And the amendment at the bottom of the slide introduces relief from having to account for the deferred tax impact of the Pillar 2 model rules for those multinationals that are affected by those rules. So I won't go into those amendments in detail now, but if you have questions, please feel free to ask in the chat, and I encourage you to have a look at those amendments. And then moving on to amendments that will become mandatory for December 2024 year ends and also for March, June, September, and 2025 year ends. There is one specific amendment here that I wanted to sort of focus a bit more about, and Michelle already mentioned it. It's the disclosure of fees for audit firm services. So just a quick rundown through the rest of the amendments before I get onto that one. So firstly, we have lease liabilities in a sale and leaseback. So these amendments clarify the accounting for a sale and leaseback transaction after the date of the transaction. And we've also got amendments called supplier finance arrangements. So these amendments require disclosures to increase transparency about a reporting entity's supplier finance arrangements, if you have them, and their effect on the entity's liabilities, cash flows, and exposure to liquidity risk. We've also got non-current liabilities with covenants, and I believe we covered this one in a reasonable amount of detail in our last need to know session last year, so I won't do it now. But in any case, these amendments clarify how covenants, with which an entity has to comply with within 12 months after the reporting period, affect the classification of the liability as current or non-current. And so the amendment that I wanted to spend, I suppose, a little bit more time on today is disclosure of fees for audit firms' services. So this was an amendment that we issued last year as a result of a domestic New Zealand project. So let's look at it in a bit more detail in the next few slides. So the amending standard disclosure of fees for audit firm services amends the standard called IFRS 44 New Zealand additional disclosures. The amending standard introduces enhanced disclosure requirements about fees that the reporting entity incurs for services provided by the entity's audit or review firm. In other words, the firm that audits or reviews the entity's financial statements. As a reminder, for a number of years now, entities reporting in Tier 1 have been required by IFRS 44 to disclose the fees for each auditor or reviewer of its financial statements, including network firms, separately for the audit or review of the financial statements and for other services performed during the reporting period. So having disclosure requirements relating to fees for audit firm services is not in itself something new in New Zealand for-profit accounting standards. But in recent times, we have been hearing calls in New Zealand to improve the transparency and consistency around disclosures provided in the financial statements about fees for the different types of services that reporting entities receive from the audit firms. So in response to these calls, we have issued disclosure of fees for audit firm services, which enhances the existing disclosure requirements relating to fees for services provided by the audit firm in IFRS 44. And these enhanced disclosure requirements apply to Tier 1 reporting entities. And there are also disclosure requirements for Tier 2 entities, but there are disclosure concessions for Tier 2. And just to let you know that we have introduced similar disclosures for public benefit entities in Tier 1 and Tier 2. The enhanced disclosure requirements are mandatory to apply for periods beginning on or after 1 January 2024, and comparative information is required. And we have previously presented a webinar focusing specifically on these amendments on disclosure of fees for audit firm services. And there is a link to the recording of this webinar on the slide. So you are very welcome and in fact encouraged to watch the recording of that webinar for more information about these amendments. So I'm not going to go through the enhanced disclosure requirements in a lot of detail today, but I will give you an overview on the slide. So in summary, the amendments require reporting entities to disclose the fees incurred during the reporting period for services received from the audit or review firm using specified categories. Firstly, there continues to be a requirement to disclose the fees for the audit or review of the financial statements. But what is new is that if the audit or review firm provides the reporting entity with other services, in addition to the financial statements audit or review, the entity would be required to disclose these fees for those non-audit services using specified categories. So these specified non-audit categories are audit or review related services. Then we have other assurance services and other agreed upon procedures and engagements, taxation services, and all other services. And for each type of service classified in these categories, entities will need to disclose a description of the type of non-audit service and the total fee incurred for that type of service. The other thing that's new is that Tier 2 entities will be required to provide disclosures about fees for services provided by the audit review firms. But as I said, there are some disclosure concessions. So entities in Tier 2 don't have to use the specified categories for non-audit services that are shown in light blue on the slide, but they will need to disclose the total fees for the audit review of the financial statements and also the total fees for other non-audit and non-review services provided by the audit firm, with a general description of these services. The objective of these enhanced disclosure requirements is to provide information that will help users of financial statements to assess the extent to which non-audit services have been provided by the entity's financial statements audit or review firm. And as we explained in the basis for conclusions of the amending standard, this information tends to be seen by users of financial statements as a key indicator, albeit definitely not the only indicator, for the assessment of auditor independence. So this is something that's worth keeping in mind when applying the disclosure requirements. So this was just a high-level overview, and there are more detailed requirements and more detailed guidance in the amending standard, including guidance on how to classify non-audit and non-review services provided by the audit firm into those specified categories that I mentioned. So as I said, I recommend having a look at that webinar recording that we linked in the previous slide, and also having a look at the amending standard itself. And just to finish off this section, on this slide, we have new standards and amendments that apply in future years. So we have lack of exchangeability, which explains how to determine whether a currency is exchangeable into another currency, and it also introduces requirements and guidance on how to translate transactions and balances when the currency of the transaction is not exchangeable. In my understanding, these amendments are likely to have limited applicability in New Zealand unless your organization operates in countries where whose currency is not easily exchangeable into New Zealand dollars or another currency. And last but not least, definitely not least, we have the pretty much hot off the press NZ IFRS 18 presentation and disclosures in financial statements. So this standard is mandatory for periods beginning on or after 1 January 2027, but I think it would be important to start preparing early for the implementation of the standard. And I will pass on to Carly now to give you some more information about this very important new standard.
Right. Thank you, Gali, and hello, everybody. See if I can get onto my slide. Right. So, in a significant new development in for-profit reporting, we issued NZ IFRS 18 last month. The standard is equivalent to IFRS 18, which is the culmination of the ISB's project to improve the reporting of financial performance. In particular, IFRS 18, and therefore NZ IFRS 18, is expected to provide investors with more transparent and comparable information about an entity's financial performance and give them a better basis for analyzing and comparing companies. NZ IFRS 18 focuses only on presentation and disclosure. Therefore, the standard will not affect how entities measure their financial performance and the overall profit figure. So how does NZ IFRS 18 fit within the for-profit suite of standards? NZ IFRS 18 replaces NZ IAS 1, presentation of financial statements, when applied, either from the mandatory date of 1st of January 2027 or earlier as permitted by the standard. Some of the existing requirements in NZ IAS 1 have been carried over into NZ IFRS 18 with minimal wording changes, while other requirements have either been moved into other standards, such as NZ IAS 8 and NZ IFRS 7, or replaced with new requirements. Therefore, NZ IFRS 18 will affect all for-profit reporting entities. These new requirements, which I've just mentioned, fall within three main sets within NZ IFRS 18, as indicated on the slide. Now, there is a lot to take in with these new requirements and plenty to become familiar with. And So there is enough time today to provide you with only a very high-level overview of what they are. In the coming months, we do plan to hold sessions focused exclusively on NZ IFRS 18, which will enable us to take a deeper dive into the new requirements. And later on, I will also highlight the resources that the ISB has made available on their website. I will now move on to the first of the three sets of requirements, which concern the categories within the statement of profit or loss and two new required subtotals. Now, the purpose of the new requirements around categories and subtotals is to create a consistent structure for the statement of profit or loss, thus improving comparability across all entities. There are now 5 categories within the statement of profit or loss. These are operating, investing, financing, income tax, and discontinued operations. I will now elaborate further on the first 3 categories. So the operating category includes all items of income and expense arising from an entity's operations, regardless of whether some of these items are recurring or non-recurring, volatile or unusual in some way. The result is intended to be a complete picture of an entity's operations. The operating category can also be seen as a default category, as it includes all income and expenses not classified in one of the other categories. The first of the 2 new required subtotals, which is operating profit or loss, includes all amounts classified in the operating category and provides a useful and consistent starting point for investors when forecasting future cash flows. The investing category includes income and expenses from assets that generate a return separately from an entity's business activities. Examples include rental income from investment property or dividends from shares held in other companies. Classifying income and expenses in this category will allow investors to analyze returns from standalone investments separately from an entity's operations. The share of profit or loss from equity accounted investments such as associates and JVs is also included in this category, regardless of whether these investments are seen by the entity as being integral to its operations. Income and expenses from cash and cash equivalents are also specifically included in this category. And the second new required subtotal, which is profit or loss before financing and income tax, comprises operating profit or loss and all income and expenses classified in the investing category. And lastly, the financing category includes all income and expenses on liabilities relating to the raising of finance. So for example, interest expense on bank loans. The financing category also includes interest expense on other liabilities, such as, for example, lease liabilities. And so ultimately, the financing component on all liabilities will be classified in the financing category. Now, at this point, I do want to touch briefly on a new concept in NZ IFRS 18, which is that of a specified business activity. Now, the standard requires entities to assess whether they invest in assets and or provide financing to customers as a main business activity. An entity with one or both of these specified main business activities would classify in the operating category some income and expenses that would have been classified in the investing or financing categories if the activity were not a main business activity. Entities such as banks and insurers would likely have one or more of these main business activities. And in most cases, banks and other entities that provide financing to customers as a main business activity would not present the profit or loss before financing and income taxes subtotal. Now, before I move on to an example on the next slide, I also just want to highlight that NZ IFRS 18 does provide cost relief in certain situations where classification of income and expenses may be a little tricky. So for example, the standard requires foreign exchange differences to be classified in the same category as the income and expenses from the items that give rise to the differences. Therefore, foreign exchange differences on a receivable would be classified in the operating category, whereas foreign exchange differences on a debt instrument would likely be classified in the financing category. However, if applying this requirement to a particular transaction would involve undue cost or effort, an entity may classify those foreign exchange differences in the operating category. Now, this slide sets out an example of what the statement of profit or loss would look like under NZ IFRS 18. The category headings are for illustrative purposes only. The standard does not require them. The line items in this example are also for illustrative purposes only. Each entity will be guided by the requirements of NZ IFRS 18 as to which line items will be presented in the financial statements. I will discuss the guidance on the aggregation and disaggregation of information towards the end of this session. And finally, this example is for an entity that does not have one of the two specified main business activities I referred to earlier. The ISB has developed illustrative examples to show how the statement of profit or loss would look for entities with these activities. I will now move on to Management Defined Performance Measures, or MPMs for short. So MPMs are non-GAAP measures, which are also known as alternative performance measures. Such measures are not defined by NZ IFRS, and many entities provide this type of information as part of their communications with investors, who will use it to gain insight into how management views financial performance and how the entity is managed. However, investors had concerns about the nature and extent of the information received on these measures and the lack of explanation in some cases, which may accompany a change in a non-GAAP measure. Therefore, NZ IFRS 18 introduces the concept of an MPM. This slide sets out the criteria that must be met for an MPM to exist. It is important to know whether a non-GAAP measure is an MPM, because there are specific disclosures that must be made in the financial statements about MPMs. So firstly, the measure must be a subtotal of income and expense. Adjusted operating profit or adjusted EBITDA are examples of subtotals of income and expense. Measures such as free cash flow, as well as measures relating to assets and liabilities, are not MPMs because they are not subtotals of income and expense. It's also important to note that NZ IFRS specified subtotals of income and expense are specifically not included here. So for example, operating profit. NZ IFRS 18 also specifically states that gross profit and similar measures, such as net interest income for financing institutions, are not MPMs, as these measures are commonly used and well understood, and therefore specific disclosures are not required. Next, the measure must be used in public communications outside the financial statements, such as press releases and investor presentations. Oral communications, transcripts of oral communications, and social media posts are explicitly excluded for the purposes of identifying MPMs. And then finally, a measure must communicate management's view of an aspect of financial performance of the entity as a whole. NZ IFRS 18 presumes that a measure that is used in public communications outside of the financial statements communicates management's view. However, an entity can rebut this presumption if it has reasonable and supportable information for the assertion. NZ IFRS 18 contains guidance on what may constitute reasonable and supportable information. Now, this slide sets out the specific disclosures required for those MPMs identified using the criteria on the previous slide. All disclosures relating to MPMs must be made in a single note in the financial statements. So in summary, NZ IFRS 18 requires explanations of why the MPM is reported, how it is calculated, and any changes to the MPM. A reconciliation back to an NZ IFRS defined subtotal is also required. This reconciliation must include the income tax effects and the effect on non-controlling interests for each reconciling item. Determining the income tax effects could be complex, and so the standard does allow for a simplified approach. Now, all these disclosures are intended to provide transparency on these measures to investors. The requirement to disclose this information in the financial statements does mean that the information will be subject to audit. Excuse me, that is too far. Now, the third set of requirements relates to the grouping or aggregation and disaggregation of information. But before getting into these requirements, it is useful to keep in mind what the objective of financial statements is. It is to provide useful information to users. To achieve this objective, an entity will present information in the primary financial statements and disclose information in the notes. Please note only material information needs to be presented and disclosed. The primary financial statements and the notes each have a role to play in providing this useful information to users. These roles are specified in NZ IFRS 18, and an entity must use these roles to determine where to include information in the financial statements. So what are primary financial statements? These include the statement of profit or loss, the statement presenting comprehensive income, and the statements of financial position, changes in equity, and cash flows. The role of these primary financial statements is to provide useful, structured summaries of income, expenses, assets, liabilities, equity, and cash flows for investors. Now, this is a key principle in NZ IFRS 18. So entities are required to present line items and subtotals in addition to those specified in NZ IFRS, if necessary to provide a useful structured summary. Such subtotals may be MPMs if the criteria are met. Likewise, an entity is not required to present a line item specified in the standard if doing so is not necessary for the statement to provide a useful structured summary. Now, the role of the notes is twofold. The notes provide material information to enable investors to understand the line items in the primary financial statements. The notes also provide material information to supplement the primary financial statements with additional information to achieve the objective of the financial statements. Now, these roles feed into the general principles of aggregation and disaggregation of information, which are to place items in the primary financial statements and the notes to fulfill their complementary roles, aggregate items that share characteristics, and disaggregate items that have different characteristics, and group items in a way that does not obscure material information or reduce understandability. Now, NZ IFRS 18 explicitly states that an entity can label an aggregation of items presented or disclosed as other, only if it cannot find a more informative label. The standard provides some guidance on how such a label can be found, and if such a label cannot be found, then it must be as precise as possible. So, for example, other operating expenses. Depending on the nature of the items within the aggregated amount, further disclosure may be required to help users understand the aggregation better. Now, this slide covers the presentation of expenses in the operating category. Expenses must be presented in the operating category in a way that provides the most useful structured summary of the expenses. To do so, an entity must classify its expenses based on their nature, or function. NZ IFRS 18 permits a mix of nature and function classification if this will provide the most useful structured summary. If an entity classifies its excuse me. If an entity classifies its expenses based on function, additional information on the nature of certain specified expenses must be disclosed in the notes. These are depreciation, amortization, employee benefits, impairment losses and reversals, and write-downs and reversals of inventory. Now, this brings me to the end of the high-level overview of the key new requirements in NZ IFRS 18. The slide notes some other changes as a consequence of the new standard. So there are some limited changes to NZ IFRS 7, Statement of Cash Flows. Amendments to NZ IFRS 7 specify that operating profit must be used as the starting point for reporting cash flows from operating activities using the indirect method. Also, most entities will be required to classify dividends and interest paid in cash flows from financing activities, and to classify dividends and interest received in cash flows from investing activities. These changes will aim to simplify practice and reduce diversity in presentation. Please note that the ISB is embarking on a project on the statement of cash flows to address other concerns from stakeholders raised during the ISB's third agenda consultation. And amendments to NZ IFRS 33, earnings per share, and NZ IFRS 34, interim financial reporting, have also been made, relating mostly to the new concept of MPMs. Now, before I wrap up this session on NZ IFRS 18, I want to emphasize again that this was a high-level overview of significant new requirements for for-profit reporting entities. As mentioned previously, we do intend to provide more in-depth sessions on NZ IFRS 18 in the coming months. In the meantime, you can find the standard basis for conclusions and illustrative examples on our website. The ISP also has supporting materials, including recordings of its deep dive webinars. I do encourage you all to have a look at these materials, as they provide more detail on the new requirements and the rationale for their development. And as you'll see, links are provided there on the slide. Now I shall move on to the next session in the Need to Know, which covers recent agenda decisions issued by the IFRS Interpretations Committee. Now, before getting into these, I'll just give you a brief reminder of the purpose of the committee and the status of agenda decisions. The main activity of the committee is responding to questions about the application of IFRS accounting standards to support consistent application across jurisdictions. The committee response may include developing explanatory material, which is published as an agenda decision. Now, these agenda decisions cannot add or change requirements in the standards. Instead, they explain how the applicable principles and requirements in the standards apply to a transaction or fact pattern described in the agenda decision. Therefore, when preparing your financial statements, you do need to consider the committee's agenda decisions and ensure that your accounting policies align with their conclusions. Now, this slide sets out a list of those agenda decisions issued by the committee since our last Need to Know session in August 2023. If any of these titles sound relevant to you, then I do encourage you to look up the detail after this webinar. However, I will take you through one of the most topical agenda decisions, which concerns climate-related commitments and was issued fairly recently. So the committee received a excuse me. The committee received a request to clarify if an entity's public commitment to reduce or offset its greenhouse gas emissions constitutes a constructive obligation which should be accounted for as a provision under IS 37. So in the fact pattern, the entity publicly stated its commitment in 20X0 to gradually reduce its annual greenhouse gas emissions by at least 60% by 20X9, and to offset its remaining annual emissions from 20X9 by buying and retiring carbon credits. The entity also published a transition plan and took other actions that publicly affirmed its intention to fulfill its commitments. So the committee considered three questions. First, is there a constructive obligation? IS 37 defines a constructive obligation as one that derives from an entity's actions where, by an established pattern of past practice, published policies, or a sufficiently specific current statement, the entity has indicated to other parties that it will accept certain responsibilities. And as a result, the entity has created a valid expectation on the part of those other parties that it will discharge those responsibilities. Secondly, if there is a constructive obligation, does it create a provision under IS 37? Our provision is only recognized when the following three criteria are met. So where there is a present obligation, which is legal or constructive, as a result of a past event, it is probable that an outflow of resources embodying economic benefits will be required to settle the obligation, and a reliable estimate can be made of the amount of the obligation. And lastly, if a provision is recognized, is the corresponding amount recognized as an expense or an asset? So the committee concluded that in the fact pattern described, whether the entity's statement creates a constructive obligation to fulfill its commitments will depend on the facts of the statement and the circumstances surrounding it. In the case where the statement does create a constructive obligation, the entity does not recognize a provision when it makes the statement in 20X0, because at this time, the constructive obligation is not a present obligation as a result of a past event. neither stating a commitment nor taking actions that affirm the entity's intention to fulfill that commitment are events that create a present obligation. The events that create a present obligation are the events to which the statement applies, and those events have not occurred at the time the entity states its commitment. Between 20x0 and 20x9, again, the entity does not recognize a provision because it does not have a present obligation as a result of a past event until it has emitted the greenhouse gases it has committed to offset. As the entity emits greenhouse gases in 20x9 and beyond, it will incur a present obligation to offset those past emissions. If the entity has not yet settled that obligation and a reliable estimate can be made of the amount of the obligation, the entity recognizes a provision. And as to whether a corresponding expense or asset would be recognized, the committee noted that if a provision is recognized, the corresponding amount is recognized as an expense, and this gives rise to or forms part of the cost of an item that qualifies for recognition as an asset. Now, this is a high-level summary of the conclusions in this agenda decision. The full content of the agenda decision can be found on our website. And we do also expect to release an XRB explainer video on this decision within the near future. So I shall now hand over to Gali. Thank you.
Thank you, Carly. Let's see if I can get control over the slides again. Yeah, looks like we can. Great. So I'm just going to give you a quick overview of new standards and amendments that are on the horizon. So that includes amendments recently issued by the IFSB, where we're in the process of adding these amendments into New Zealand for-profit standards, and also consultations on proposed amendments and other ISB projects, which may result in new standards and amendments that would ultimately apply to for-profit entities in New Zealand. So here on the slide, we've got IFRS 19 subsidiaries without public accountability disclosures. So the ISB recently issued IFRS 19, and the standard allows eligible subsidiaries to prepare their financial statements under reduced disclosure requirements while still complying with the full recognition, measurement, and presentation requirements in full IFRS accounting standards. As you probably know, in New Zealand, we already have something similar. In other words, we have our reduced disclosure regime for Tier 2 for-profit entities, but of course, Tier 2 entities don't have to be subsidiaries. Also, the current disclosure concessions for Tier 2 for-profit entities in New Zealand are not quite the same as the concessions provided for eligible subsidiaries in IFRS 19. So we are currently considering whether and how to update the Tier 2 for-profit disclosure requirements in light of this recently issued IFRS 19. The NZIFRS still has some decisions to make in this regard, and we are expecting that there will be a forthcoming consultation on Tier 2 for-profit disclosure requirements. Of course, the content of that consultation will depend on the outcomes of the NZIFRS forthcoming discussions. And so once when we do start the consultation, we will be getting in touch to ask for your feedback when that happens. And this one here is very much hot off the press. Last Friday, New Zealand time, the ISB issued amendments to the classification and measurement of financial instruments. These amendments were issued in response to some concerns that arose during the post-implementation review of IFRS 9, which is the financial instruments standard. The key amendments in this pronouncement include amendments to clarify the classification of financial assets with ESG-linked features, like, for example, a loan that you advance to another organization where the interest rate that you charge depends on whether the borrower achieves certain environmental, social, or governance-related goals. The classification of financial assets is important because it's linked to measurement. So in other words, classification determines whether you measure the financial asset, like the loan I mentioned, at amortized cost or at fair value. And this is what the amendments clarify. There are also amendments relating to the derecognition of liabilities that are settled via electronic payment systems. So we will be asking the NZASB to approve the issuance of these amendments in New Zealand this month, and the expected mandatory date will be 1 January 2026. I also wanted to let you know that we are consulting on two IASB exposure drafts containing proposed amendments to accounting standards. The first exposure draft release is called Business Combinations, Disclosures, Goodwill and Impairment. You may remember the last time that the IASB consulted on this topic, so I should just confirm and clarify that this time around, the IASB is not proposing the reintroduction of goodwill amortization. So we are sticking with impairment only requirements for goodwill. But what this exposure draft does propose is to introduce new disclosure requirements about acquisitions of businesses. So that includes requirements about the objectives of the acquisition and the subsequent performance of certain types of acquisitions. And the exposure draft also includes some targeted proposed improvements relating to the impairment test for goodwill. The overall aim is to improve the information provided in the financial statements about business acquisitions. And feedback on this exposure draft is due to the XRB by the 14th of June, which is actually not too far away now. The other exposure draft that we're consulting on is called Contracts for Renewable Electricity. This exposure draft aims to allow reporting entities to more accurately reflect the effect of contracts for renewable electricity on the financial statements. So these contracts are often structured as power purchase agreements. So you may have been referring them as power purchase agreements. And typically they involve an agreement to purchase all or a portion of the electricity produced by a renewable electricity generator for an agreed price. The customer might receive the electricity directly from the renewable electricity generator in the case of a physical power purchase agreement, or otherwise it might come indirectly via a retailer in the case of a virtual power purchase agreement. And so the ED exposure draft, proposes to make it easier to apply the own use exemption in IFRS 9 to physical PPAs, meaning that they would not need to be accounted for as derivatives, and also to make it easier to apply hedge accounting requirements to virtual power purchase agreements under IFRS 9. So the feedback on this exposure draft is due to the XRB by the 18th of July. We would really appreciate hearing your feedback on those two exposure drafts. So I would encourage you to have a look at the exposure drafts using the links that are on the slide and sharing your views with us. This slide here just shows some other forthcoming consultations about proposed IASB amendments to standards. And I won't go into those in detail, but I'll just say keep an eye out for our communications relating to those consultations when they begin via our newsletter or on LinkedIn and on our website. And finally, for completeness, this is just a list of some other IASB projects that are currently on the go, projects that the IASB is working on and their next steps. So these projects might result in changes to accounting requirements for New Zealand for-profit entities once these projects are finalized. And when that happens, we will we'll be talking about them in future need to know webinars. So that is actually all that we had in terms of the presentation content. And now I think we'll open the floor to any questions.
We have tried to answer questions as we went along. So I think for the most part we had. There's one open question now. Carly, a question regarding accounting framework, please. Has special purpose been replaced with Tier 2 RDR yet in New Zealand? This was applicable 30 June 2023 here in Australia.
I can take that one. Sure. So yeah, Australia has a different reporting framework and a different legislative environment. So what they've done there with their Tier 2 entities has not affected us. We are in the process of looking at our own RDR in light of the fact that IFRS 19 has been issued by the IASB. So in future, shortly, we are, or the board, the NZASB is considering the nature and content of a consultation on NZ IFRS RDR and the impacts that IFRS 19 would have here in New Zealand.
Great. Any other questions? I think one of the questions that came up is whether or not we'll make these slides available. Yes, we will. It will be loaded on our website soon, hopefully later today / tomorrow. But yes, we will. I think then we have answered everybody's questions. If there's any other questions, now's the time. Okay, great. If there's any questions that you do have on these slides or any other topic that you're keen on or have more questions on, happy for you to just drop us an email, and we'll happily be in contact and try and resolve those questions as soon as possible. Thank you very much for joining, everybody. Have a great day, and we'll close the seminar or webinar now.